Hi everyone, welcome to my channel Stannis Investor. Today I'll be talking about cash flows. And if you haven't subscribed to my channel yet, then please do subscribe so that you don't miss out on my videos, as well as the stock analysis of small and mid-cap companies. And the PQC is of my Twitter account. You can follow me on Twitter as well. Today I'll tell you what cash flow is, the importance of it, and how P&L statements can be deceptive at times and cash flows give you the real picture. So what is cash flow? Cash flow is the net amount of cash and cash equivalents being transferred into and out of a business. At the most fundamental level, a company's ability to create value for its shareholders is determined by its ability to generate positive cash flows. Why is cash flow important? The cash flow report is important because it informs the reader the cash position of the business. For a business to be successful, it must have sufficient cash at all times. It needs cash to pay its expenses, to pay bank loans, to pay taxes, and to purchase new assets. Now let's see the categories of cash flows. There are basically three types of cash flows. First one is cash flow from operating activities. Second one is cash flow from investing activities. And the third one is cash flow from financing activities. Now let's see all these three types in detail. The first one, cash flow from operating activities. This includes cash activities related to net income. For example, the cash generated from sale of goods and the cash paid for merchandises are operating activities because revenues and expenses are included in net income. This also includes depreciation, loss of sale of assets, gain on sale of investments, and changes in working capital. The cash flow from operating activities should always be a positive number. Now moving on to the second one, that is cash flow from investing activities. This includes the cash activity related to non-current assets. The non-current assets include long-term investments, property, plant and equipment, and principal amount of loans made to other entities. For example, cash generated from sale of land and cash paid for an investment in another company is included in this category. The cash flow from investing activities should always be a negative number. If it's positive, then it means the company is selling its assets instead of buying them. Now moving on to the third one, cash flow from financing activities. This includes cash activities related to non-current liabilities and owner equity. Non-current liabilities include principal amount of long-term debt, stock sales and repurchases, and the dividend payout. The cash flow from financing activities should always be a negative number. If it's positive, then the company is taking on more loans instead of paying back the loans. So the thumb rule is cash flow from operating activities should always be a positive number. Cash flow from investing activities should be negative, and cash flow from financing activities should also be negative. While in some cases, when the company is expanding or is undergoing a capex, then the cash flow from financing activities would be positive, as the company would be raising debt to acquire new assets. Now let's see an example where the P&L statement gives the wrong picture of the company while the cash flows give you the right one. Now let's look at the financial statements of the company Inox Wind. It's a company that makes windmills. Let's look at the numbers for March 15. The net profit before tax declared was around 440 crores, but the net cash from operating activities was a negative figure. Although the net cash from investing activities was negative, which is good, but the net cash from financing activities was around 950 odd crores. That means the company was taking on huge debt. Similarly, in March 16, the net profit before tax surged from 440 to around 660 odd crores. But the net cash from operating activities was still a negative number. While the net cash from investing activities was negative, which is good, the company still took around 500 odd crores debt. Now looking at the stock performance during the same time, while a retail investor who just looks at the P&L statement and the EPS would find nothing wrong with the company. But someone who understands cash flows would know that the company is not generating any revenues from its operating activities but taking on more debt. So you can see the chart from around 440 levels in 2015, the stock fell to around 115 after March 17 results. By understanding cash flows and not just relying on the P&L statements, an investor can benefit and take the right decisions while investing. So that's all for today's video. If you have any doubts, you can write them in the comment box and I'll answer them for you. Thank you.